This is Keys to Cayman unlocking real estate investment and opportunity in the Cayman Islands. Hosted by Mod Realty, bringing you market insight from the inside. From homes to smart investments, we give you the keys to move with confidence.
Keys to Cayman unlock the market. Own the advantage.
Okay, welcome everybody to Mod Realty Podcast Keys to Cayman. We're back for another episode, and today that we have with us again my fellow co-host Athena, founder and director of Mod Realty, and today we are joined by a special guest Michael Sanford, founder and managing director of FinCay. Thank you for joining us, Michael. How are you doing today?
Thanks, I'm doing great. Thanks to be on.
And Athena, how are we doing? I'm loving the background. Very relevant.
Yeah, just keeping nice and dry here today. We have great weather. Thank goodness.
We're always happier when it's good weather, right? So we are going to obviously dive in today around mortgages, money, and affordability. So we're going to be talking about everything to do with numbers and trying to take the fear out of that process when purchasing in Cayman. But first note, obviously we mentioned it in episode 1, and just to reinforce the fact that everything that we discuss on this podcast is based off professional experience and lived experience within the Cayman Islands property market. So all the views shared are of those all on the podcast and are not intended to represent any government body or third-party organization. So we are speaking in capacity of us as Mod Realty and obviously Michael on behalf of FinCay. So without further ado, let's get into it. So mortgages, a big one. Lending, borrowing money, a big one. So Michael, obviously you're on here to be our fountain of knowledge today for all of our listeners and clients and people who essentially are quite intimidated by the process. And a lot of that comes down to, I've maybe never borrowed before. Where do I even begin? So that's quite a big question to start with, but what would be kind of the first thing initially if you were to have somebody come to you and say, look, I'm looking to borrow to purchase, where do I start?
Yeah, I mean, everybody starts obviously, contact your loan officer, start going through the process, downloading all the applications and getting all the auxiliary documents that you start needing to collate to have as part of your application. Where we tend to deal with things more from a FinCay point of view is a lot of our clients, which are business owners, will come and say they're either looking to do residential mortgages, personal mortgages, but typically with a bank, they will require them to provide a set of financial statements that goes with showing how their business is performing, along with a verification of their income letter. And that is sort of a similar process if they're looking to do, they want to get a commercial property, which is tied to the business. So the business is looking to acquire a mortgage, and that's a slightly different process. But so each one has, it comes case by case, I would say.
Sure. And, obviously when we're looking at, we'll get a bit more of a deeper conversation into the types of people that are coming and the requirements that differentiate based off of that. Just coming to you, Athena, whilst we're on the topic of, first steps. Obviously we did in the first episode, we talked a lot about pre-qualification when it comes specifically to purchasing. So that's usually the first point of reference that somebody is going to, we're requiring for somebody who's coming to purchase with us, and obviously the initial phase is then finding the right bank, the right, lender, etc. And developing that relationship with the loans officer. What are the key things from your perspective, Athena, when you are looking at that first step? Because we know that we have a lot of different clients who, maybe approach things in a slightly different way. But I know that you've, got some thoughts on, kind of making sure that you approach it in a way that's going to kind of build a long-lasting relationship with that lender as well. So keen to hear your thoughts on that one.
Just to understand correctly, you want to know how purchaser can build a relationship with a lending officer prior to, or like
Yeah,
building a
just around
relationship?
that first initial phase when somebody's going to lend to borrow, that it's not just a transactional relationship, right? As well, that it's important that they build that relationship with the person as an individual, as well, because they're going to have a lot of contact with them over that period.
I believe part of building the relationship with a lending officer would be starting with a savings plan, because you'll be looking at your bank statements to see if you have a good savings plan. Let's say you're putting money away monthly, if weekly, and then if you're self-employed, if you are putting money away for yourself as a savings, which is very important because a lot of self-employed people, what they do is a lot of them get paid last. So like what they always say, to make sure you pay yourself first as a business owner. So definitely just having a financial savings plan. That way the bank is aware that you are a good nominee for a mortgage or for whichever loan you want, whether it's a business loan as well. And I do think that this is important for before the pre-qualification. Sometimes what the bank will do is they'll give you a credit card too. And that would be to test your credit and see if you can keep on top of paying the credit card back and how you utilize your money.
Sure. So that savings plan's important, building that relationship, going, and then obviously taking next steps to the loans officer. And I guess, Michael, from your perspective, are there anything that typically people come underprepared with when they're coming to and, to access your service? And what does that usually look like?
A lot of times. So there'll even be situations where we'll partner with, say, Mod Realty as an example. Athena may say she has a client, they have a business, but they don't have a set of accounts. And the bank is requiring, depending on, they've already did a risk assessment on where that client, depending on what type of business profile they are. And one of the things is a lot of small business owners, they don't have a proper set of accounts. It's the last thing on their priority list when they start a business, when it should be one of the first things in your foundation, whether it's something that you're piecing together and maybe you have someone come in and set things up so that you can plug numbers here and there because cost wise. So a lot of times we unfortunately get cases where people are referred to us and we have to almost start from scratch with them. And it's a process that we have to educate them a lot on. But just to add a little bit what Athena was saying earlier, when it comes, a lot of times too, we'll partner with real estate agents or real estate brokers like Mod Realty, and they may even have a client that is going to put an offer on something, but they're not too sure exactly where this person lies. It's sometimes we kind of can even assist them from like weeding out offers and stuff like that. We can look really closely and we can almost say, because we already kind of have the formula on how it's done on the back end with the banks, with working the banks before. So we can almost say whether this person is going to qualify or not, or we can go through, but they'll maybe spend thousands of dollars, we'll put together their financials to get all this done, but they may not still qualify for this. So you as a broker mightn't necessarily want to have to juggle and waste your time with that person. And you might want to be more direct and therefore be able to say, based on outside consultancy, I don't think you're going to be able to qualify for this. Still double check with your loans officer still, because they may have some flexibility in there for how they're determining your debt service coverage ratio. But again, I can a lot of times we can calculate that off the back end for them as well, to tell them whether to waste their time or not.
Yeah. And just coming to Athena on this one as well, because, obviously you mentioned about, obviously it does impact us as real estate agents in terms of the time, but we're particularly passionate about our clients not wasting their time as well, and just being realistic, because often we see that, for example, they're in the process of viewing a property and they've fallen in love already. They've been on a showing, and and then unfortunately, it's like a retrospective thing. They're then like, I can't afford this, and it's taken them a lot of time as well, isn't it? So, Athena, just on that piece for you, I know that often when we're having that conversation, that dialogue with clients, which is why we mentioned so hard about pre-qualification, is because we don't want them wasting their time, right?
So it's all a process. You may get pre-qualified now, and understanding the reasons why you're not qualified now will help you to be better prepared in the future, where both the lender and FinCay, to whom would have done your financials, can more of advise you on how to better prepare in the future to obtain the mortgage, whether it is being able to save X amount of dollars towards your total closing costs, knowing what you qualify for when it comes to the concessions, and also learning how much you need to make on average to qualify for this loan, which will help people who are, maybe seeming to climb on the property ladder, or who is going to obtain a mortgage in future as a joint partnership, whether it's their husband or wife, or someone willing to sign as a co-signee.
Yeah, just to
100%.
piggyback off of that as well. A lot of times, you can tell right off of the bat whether sometimes they have everything already, and it's like what Athena was saying as well. It's like they mightn't be there right now today, February 2026, but now they've already got that 3 years of financial statements done. They've locked that in. They already know where they are, where they stand on that qualification point. They might be, maybe they need a over time gain more revenue, more profit, et cetera, et cetera. And so now in a few months or a year from now, it's just a matter of they are not starting from day one. They have like this, they have the documentation, they know the process, the history, and it's just it's pretty much kind of cut and paste at that point. And,
Sure.
you can just all plug it in and get them through the process as quickly as possible to closing.
And, we're talking about a big foundational understanding of just finance and numbers, point blank, because some people, it's just they're business owners or their employees, and their brains are just, they're not financially, driven by numbers or figures and things. So I suppose, in terms of your services, a lot of that educational piece and kind of supporting and hand-holding is building their confidence as well. So just going to come back to a bit of terminology, because we've thrown a few things in here. And one thing that we're very much kind of wanting to emphasize with this conversation that we have through Keys to Cayman is breaking things down as simply as possible. So you mentioned debt service ratio, for example, Michael, DSR. So just explain to listeners, what does that even mean if somebody's never heard of that, and how does that impact on their ability to borrow?
Yeah. So again, too, it depends on that. You will be measured, your debt servicing ratio will be measured on your personal finances if it's a personal loan, as well as if it's a commercial loan, the debit, and it's tied to the business. So the business is acquiring a property. The debt servicing ratio is actually measured on the net profit. So in other words, a bank usually hedges its bets. So they will have a certain coverage, a certain amount that they're willing to allow as a percentage of you to have as your debt to income. So in other words, they may say 40% of is the limit we're allowing you to have as total debt, right? So that could be car loan, that could be personal loan, that could be your residential mortgage. So if you're making $100,000 a year, they would basically calculate and know that you have $40,000 worth of debt that they're willing and it'll allow you to have within that. Now, in my experience, one of the things we see is that what we try to do when we're calculating this for people to help them know where exactly they stand is that they might know where they stand with the mortgage. So they might know, okay, cool, I'm at 38, 39% with all my debt. But the bank will also look if your property has strata, or in the case if it's a private home, your residential home, then they'll actually wanna see where, if you can also, they'll kind of package into that debt service ratio your strata fee and your home insurance. So that might now actually take you up to 45, 50%, and therefore you mightn't qualify for that very reason. A lot of times you can make cases why they should allow it, but we don't. It's we try to get that problem solved before we get there. If you get what I'm
Sure.
saying. Yeah.
Sure. And I think, we talked a little bit in the previous episode around sort of quote unquote hidden fees, but things that maybe people don't anticipate. So we spoke about valuation and different pieces like that, and just general costs that come with purchasing a property, and strata, because, a lot of pre-construction, that's the insurance is included in it, but it's a fee that maybe people are not even knowing about, again, because they're so new to the whole market. So it's really important for us that people understand at what point. So if somebody were looking at a property, they know it's pre-construction, they know that it's one that's going to have a strata fee of $400-500 a month, at what point do they go to when they go to the lender? Because sometimes, if they're doing their pre-qualification, they can't necessarily anticipate which property they're going to, be selecting to go forwards with. So they don't even know if there is a strata fee or what that strata fee is. So how would you kind of advise people to handle that in that circumstance?
Well, again, too, we can make assumptions. The same thing, even on a residential home, if we're going to buy a single family home in Georgetown or Savannah, wherever it is, we can still start to say, and based on what we know on statistics, that the average home in Cayman is roughly 2% of the purchase cost. So if it's $500,000, we can do a rough estimate to say 2% of that $500,000 is going to be your home insurance on an annual basis. Those payments will obviously be divided into 12 or 10 or however you plan to pay it, but we would try and chop that down into 12 to help figure out exactly where you would land in your debt service ratio. So that's how we would proactively kind of prepare them for it, then, if you get what I'm saying.
Yeah, I see. Exactly. It's trying to predict as much as possible based off the current market, and
rather than a curveball coming at them and now we like, oh, we didn't think of that.
Yeah. And then it's
exactly, we try to, even if we know that these 10 things are coming, we solve these 8, we at least try to be prepared for the next 2, if you get what I'm saying.
Sure.
We know those things are coming. We just gotta make assumptions.
Sure. A lot of foreseeing, and I guess, typically that will happen because circumstances will slightly, differ, but a lot of the times you're finding the same and similar things. And just on that, so Athena, obviously we talked about DSR. We've talked about a couple of different things in the previous episode, but is there anything else that you find typically comes up when it comes to financing? Words, terminology, things that people are like, sorry, what is that? Or, I need to know a little bit more about that, would be helpful for listeners to really understand exactly what we're talking about when we're discussing finance and borrowing.
I can touch on the word pre-construction. So what a pre-construction is basically you're purchasing the property before the property is built, or perhaps you're purchasing the property while it is under construction. So while it is built, planning is going through its inspections to ensure that the property is built up to code. The developer or the seller will receive the certificate of occupancy once the property is finished, and that is when the property then changes to an existing property. Please note that multiple banks do offer mortgage offer letters for properties under construction. So you are able to reserve the property with your 10% down, subject to perhaps the developer's contract. What a developer's contract is a contract between the buyer and the developer, which would have the schedule of payments. The most common schedule of payment is a 10% down and the balance at closing, which would be the payout from your bank. You do seek a mortgage. Or perhaps it'll have the warranty, the specifications of the property as well. So that way it is ironclad. and
mm,
everything is in black and white. The contract isn't based on assumptions. You want to make sure that you are protected with your contracts as well. So to have a developer contract for a pre-sale, maybe the developer may be in breach of contract, but at least you can look at the contract on ways on how to remedy any obstacles that do come. So back to what I was saying, the bank is able to give clients mortgage offer letters after their mortgage is approved whilst the property is still under construction. It's important to get your mortgage offer letter because please remember that the developer is taking on 90% of the risk. You're putting 10% down, but the developer has taken on 90% of the risk in order to build a property for you. So they need to ensure that you are able to close on the property when it is fully constructed. The mortgage offer letter would be subject to the valuation, which would be after the developer obtains a certificate of occupancy from the Cayman Islands Planning Department. There's other things that have to go on during the pre-construction, whether it's stratification or having to separate each unit so they can sell individually. Of course, going through the inspections, everything that the developer has to worry about, the buyer doesn't worry about that. They literally just need to put under 10% and wait to move into their brand new property. They can apply for the stamp duty waiver after the valuation, so after CO, as the Ministry of Finance does need the stamp duty waiver. Pensions, I'm unsure if the bank would apply for the pensions when the mortgage is approved. I guess we can follow up that as well. But the main conditions is bank financing, developer's contract, and whether the buyer does qualify for the stamp duty waiver or the pension.
And just coming on to one of the bits you touched on, Athena. So deposits is a big one. And I think particularly where clients are handing over 10% of the property they're just about to purchase, it can be quite a daunting thing if they've not handed that kind of money over to anyone before. And they don't really know where it goes, what happens to it, if it's protected. Obviously, we inform them at each and every step.
Yeah.
But one of the things, it's held in our escrow account. So it's just to give people an understanding of what does that mean and how is their deposit protected in that process? Because that's, a big one for people, right?
For sure. It's important to protect your deposit. I have heard of other clients, not client of mods, who have put down their deposit for properties that have not broken ground and are having difficulties to get their deposit back. And then when I discuss these things with them, majority of them don't even have a developer's contract. So everything is in a gray area and it's not in black and white. It's very important to protect yourself. And so basically it's a 10% held in escrow. Escrow is an account where the deposit is being held. The deposit cannot be touched. So it's more of a client account. That is what escrow is for. So escrow is not an operating account where the company's expensive funds out. No, it's a whole separate account which is protected, protecting clients' deposits.
You can hear everything Athena is saying is she's very niche down into what she's saying, super detailed and analytical into the process as well. So the other thing I would just add to as well, Athena, is also letting certain terminologies, if we're on that, is loan to value, if we never discussed that before, and then the audited financials, difference between audited financials and prepared financial statements. A lot of times we see that people don't understand that when I prepare financial statements for a client, that they're not audited financials. Someone then has to come and you have to seek an auditor to go and get them audited. But in most cases, even though the language in a lot of like what Athena was saying in the mortgage letters might say that kind of terminology, you can push back by saying, we're a small business, we're roughly making $1 million a year, whatever the case is. Do we have to really get an audited financials? It's different if you are maybe the Ritz-Carlton or something like that, where you're probably getting audited anyway for different purposes. But for small and medium-sized business owners, that they're not going to find $50,000, $100,000 to get themselves audited every year. So
Mm-mm.
just also guided, like simple little things we've seen that, and we have to explain what, like, no, we do not, we're not, we can't audit our own work. Someone has to audit what we've prepared. If that,
It's like marking your own test, right? It's like you can't do it.
yeah, exactly, exactly. And then on to, and just to add to loan to value, if you guys have never brought, I'm sorry I didn't get to watch your first episode, but with the loan to values again, we'll even work with clients to try and get, once we can even get to a stage where after we prepare the financials and we get into the stage of negotiating rates and stuff like that, and the terms and stuff, we know that how the banks will look at things favorably based on things within your financials, as well the loan to value. So loan to value is basically the value of the property, and to the loan, banks will have, you'll hear things like 90% down, 100% finance, and they're basically saying that's loan to value at that point, 100% loan to value. So that's just that would be
Yeah.
the only other things I would add into the terminology section of the chat.
Really, really helpful. And I'm sure that a lot of listeners will be like, yes, I've heard this. I've not been, had it explained to me. And this is where we need to kind of break down some of these barriers, because that can really be the difference between somebody, going in and having that full understanding and being more prepared and everything like that. So, Michael, obviously at FinCay, when, somebody comes to you and, they're looking to kind of get that advice and guidance, you obviously mentioned about almost that checklist of things that you look through in terms of somebody's circumstances and their finances, to kind of help them understand what they're sort of eligible for, etc. Aside from the things that we've already discussed, what other things are kind of on that list that you're kind of checking off as you're going through, to really get that full picture, so that people know to be better prepared for some of those items?
Yeah, I mean, again, if I just kind of go back through where I started, is that, we get them to the process of knowing what the bank requires, whether it's 2-3 year financial statements, a verification income letter for the owner that's applying. We even get to the point of sitting down and working out if they're qualified for this. If we pass all those stages, and now we're in the final stretch now where they're finalizing their rates and their terms, we'll even, again, this is where we can kind of come in even before that to determine where they would stand. And so we'll use a mortgage calculator to determine, they might say, I don't want my payments above this or above that. But what we tend to do is we sit down and say, well, if you're going to do that, you need to put X amount down, because
that's going to impact.
Prime is at this, we can maybe negotiate a fixed rate, or prime +1 or prime +1.5, but it has to be based on certain requirements for the loan to value. And then the one major thing that happens when all of this is done, because they want to get the home or they want to get the property, is that they don't look at their covenants in their offer letter that they sign, and 10 times out of 10, they are required annually to provide financial statements to the bank going forward. So it's good business for me, because it's kind of grind and thinker that once you typically use that person, so anybody touching or being involved with your finances, it's probably the number one thing in life that we're all scared to let everybody know about and concerned about. So they tend to stick with that one person that they're willing to trust and open up with. So in the next year, it's usually a replication of the process again. They come back to us and say, we need financial statements to be done again, Michael, and we do the process. We do the, because now it's part of their compliance for their loan.
Right, and it's so they have to adhere to that.
And if they don't do that, they can get deducted fees. They can be penalized. Their accounts can even be closed down. So it is a serious process. And like I said, so we try to tell people, we try to encourage them to either maintain their accounts monthly with us, quarterly. Don't come to us last minute when they've said the deadline is due in 1 week, and now
Yeah.
we have the full year of stuff to do. So we try to manage that process and let them know this is going to come. This is going to come down the road. Be prepared for that.
Mm-hmm. And I suppose, in terms of keeping on top of their visibility and understanding of what their financial circumstances, it's a great thing for them, as a business anyway, to be producing those things on the regular. But going back to what we said about the development of the relationship with, anyone that we're not just the loans officers per se, but the likes of yourself, anyone that they're involving themselves with on that journey, it's super important. And we know Cayman is small, so it's even more of a reason why we want to have that trust with those that we're, discussing some of those kind of, maybe tougher conversations, because it is something that, whether it's a residential and it's quite personal, or whether it's more business focused and, looking at, diving into, maybe somebody's lifespan of their business organization that they may have built up from the ground. And actually, that's quite a big thing. So, Athena,
I would
just,
also
sorry, go ahead.
like to add regarding the deposit. Sometimes the bank does need more than the 10%. I've seen other banks needing 15, 20,
Yeah.
30%, just depending on what your income is, what your relationship, and also your age. So it's very important to know that. Also, you're able to use your equity, to use your collateral as an equity loan to purchase something else. And sometimes you don't even need closing costs if you're using collateral for an equity loan, because by then you would have already had the relationship with the lender. You already have the asset as well, and then you already have the equity, because real estate 9 times out of 10 is a asset and equity building. Property. So it's very important that before you rush to sell something, just check out how much equity you have. You can perhaps keep the old property as rental income to generate more financial. So it's important to work around what you can and cannot do. And I guess it's all about building wealth as well. So you're buying, but it's important to build wealth as well.
Well, on that point as well, remember too, the banks, if you do have an existing property and you have debt with it already, so you still have a mortgage with it, but you are renting it out using it as investment property, again, you want another property, and you want to basically say, here's my source of income. I mean, like, get over here, but I also get this rental income over here. Another thing that people typically don't realize when they're going through that process is that the bank only looks at that as 50%. So they're looking at it from a case, well, there's no guarantee chance that you'll always be fully occupied. So they'll actually say you're bringing in $1,000 a month. We'll count $500, 50% of it, right? Toward your income, your total income, which will help again toward where you qualify in all of that. So, yeah.
Just to touch on that as well, I do think it's important to calculate what you're investing your money into as well, because there's some people who want to purchase to rent out, but then they don't necessarily work out how much their monthly mortgage strata, how much their expenses are going to cost. So it does make sense to work that out before you purchase something as an investment property. That way the rental income can work in your favor. Versus if you're buying something to reside in it, you don't necessarily need it for investment. You're more of looking at it to keep shelter, over your family. So there's different reasons for why people purchase property, but it's very important to understand the financials as well.
And we, as at Mod, obviously, if we've got a property that's been an investment property previously and somebody's kind of inheriting that, we'll obviously provide the rent rolls and kind of give them an understanding of what generally they could expect. Obviously that fluctuates, but we can give you a bit of an understanding of that, and so it's just cross-referencing it to then your outgoings as well. So Michael, one of the things that often comes up, which just interested to hear your perspective on, is just kind of pensions and how that is factored into, obviously borrowing, purchasing, and just really to understand what you would best advise for people who want to maybe factor in their pensions when they're purchasing, and whether that's something that comes up a lot with your clients as well.
Yeah, I mean, honestly, at the end of the day, pensions in themselves are um I'll go on
I'll have
record.
something to add after about
I have
pensions.
after
Okay,
that
okay.
because
I've touched on a sensitive one here.
I think me and Athena probably align on this is that um pensions in themselves are a bit of a scam in the sense it's like it's your money, you know, and a lot of times the access to it is it's very difficult to get access to it. So I actually
Mhm.
try to encourage people, a lot of people, to tap into that, um, that pensions rather than your own personal cash or investment reserves that you have elsewhere.
Okay.
Because if you have something that you can, you know, you can walk into a bank or a credit union or your own investment brokerage account and you can get that money within 24 hours or 3 days. I'd rather have that than have be told by the pension provider that, you know, you'll one day get to 65 years old, you can apply for your retirement,
If you're rich.
you can have $1 million in there, and they're gonna say, okay, Michael, we only can give you a maximum of $1,500 a month according to how our Cayman Islands law works. So you're not even getting a chance to really enjoy that, whether it's enjoying it from being able to acquire your first home or um, purchase an investment property using your pension.
Mhm.
Another side of it that people don't even realize, I recently did this last year, is using your voluntary contributions as well,
Mhm. Mhm.
to be able to make improvements to your property.
Mhm.
So you can, like if you're adding a studio onto your house or you're making an improvement like um, you're adding shutters, which
Yeah.
shutters in themselves, depending on the size of your house, can be tens to
Sure.
you know 10, 15, $20,000. A lot of people don't realize that you can tap into that as well because you're employed. The money is going to that. So again, I'm a firm believer in being able to tap into your pensions because you know they were really built for people that were they were built for boomers 60 70 years ago when the cost of the living made sense for $1,500 a month.
Yes.
But in today's world, $1,500 a month
It doesn't go far.
might be
And
somebody's groceries for
Not
the
in,
yeah,
not
exactly.
in
And I can
kids with
see like
pets
the whole
over
time
10.
I can see Athena like she's like smiling and nodding, and I could even hear, she's saying like, like, exactly that. If we reach the age to which we can even access,
Not
so what we're
realistic.
kind of doing is delaying, the opportunity to be able to access the funds there as well. But like
Yeah.
you say, cost of living, if that when we do get to that point, how far is that going to stretch? And that's now, let alone in, when we reach that time. Athena, I know you got some opinions on this too.
So just to add to what Michael said about the pensions, the fine print with the pensions is yes, you can withdraw pensions from your private pension provider, not from
Yeah.
the public civil servant pension provider. So you can pull from the private pension provider. However, the fine print is if you do need to sell the property, if you do choose to sell the property, if you had not paid back your pension in full, you would need to pay back 10% of the market value of the property into your private pension. So basically, what you're doing is you're borrowing money. So that's why when you fill out your application for the private pension, there is a note in where it says that you and your employer are supposed to contribute an additional 1% towards your private pension. So in the event that that's not paid back, you have to pay the 10% back. So for example, if you borrowed $15,000 US from your pension and your property now is valued to 675 that you are borrowing, you have to put back from the deduction of the payout of your sale, $67,000 500 CI back into your private pension. So that is the fine print. I don't think that a lot of people know that. It like so for the stamp duty restriction automatically expires after 5 years. The pension restriction does not expire unless you pay that off
And it's
prior
really
to
important that
closing.
people have that foresight of, when they're, because at that point in time, right, we're just thinking it's great, we're moving in, we're gonna be here
But there's
for
fine print to everything. So
there's a
yeah,
fine print
it's
to everything, but
so the
also, you know,
professional.
the lifespan of you being in there and then wanting to move on and develop and what the impact of that is. So
Well,
really, really important.
just to add to that, what I realize is that so you can go and speak to your HR, your employee, if you're
Hmm.
employed, and you can get them to do that. They'll do a separate deduction that'll be considered voluntary, right?
Hmm.
Hmm.
So when you have the difference between the voluntary is you have, from my understanding and my interpretation of the law, is you have more direct access to your voluntary right now, whereas your involuntary, which is your contributions, your 5% and your employer's 5%, that's more, that's for your retirement down the line. So if you put it back in as voluntary, it also gives you the option later on that, because there's like 5 different options within that you can also go, and like I said, you can do improvements to your property, you can
Hmm.
pay off some kind of other debt, and you can use your voluntary contributions to do it again. And that's and it's also getting invested at the same time, so there it's
Mm.
actually growing one little bit, because the pensions funds aren't really producing any real returns, but you're getting some kind of return on your money as well. So
Yeah, so they're invested in
I would
something.
encourage people to do it that way. That way, later on down the line, I've seen people also, they have to pay for their kids' private schooling. They'll
Yeah.
use their voluntary pensions to do that as well, which will come from the same 2%
Mm.
that's being paid back.
So it's just having that same mindset that you might have for, you know, your child's education, but just in the property industry as well. And I think, you know, sometimes that's the difference of somebody saying, opening their horizons, broadening their horizons, sorry, a little bit more in terms of what they would be willing to purchase. Because sometimes they'll look at a property and they'll be like, yeah, this needs quite a bit of work, or, you know, maybe it's a bit outdated, but it's actually in a prime location. You know, it's got kind of everything structurally that it, you know, it needs, but maybe they're thinking, I haven't got the additional cash right here right now to do some of those refurbishments, you know. So that's a great option as well that maybe people haven't considered. So we're starting to wrap up now. Just briefly on that one, so Michael, if people were going to do that, they were going to draw down on their pension, what step would you advise them to take? Where do they go? How do they do it? What's the process for that?
Um, I mean, I literally came from there today. But you can either go directly in person. They have the forms in there where you can
Mhm.
simply fill out the form. You can even fill it out right then and there and submit it right then and there. Or you can go on your private pension, your local private pensions website, where you can download the document and submit it, and then they will go through the whole process of explaining what documentation do they need, what they all, some documentation they actually don't need from you, they actually need it directly from the bank. It has to be
Yeah.
a
Hmm.
bank
Yeah, so the bank
uh,
approval
a
letter
bank
to
approval letter.
withdraw pension.
Yeah. So again, it depends on how you want to do the process. Like, I personally had to do a process today where I went in person because I needed results now. So
And we know that in person usually gets a quicker response.
yeah, yeah,
Yeah,
and I was and I was dealing with them by email, and it was like there was no traction. So I literally was like, I need to get this over the line. Let me just go there, knock on the door, let them know
hi.
what
Get everything done
hey,
in
I just
time,
need
boom.
this now, and they
I'm not
literally,
leaving until it's
yeah,
finished.
they literally printed it, and I just put it in the envelope, took it with me, and that's what I needed. So sometimes that's the thing, guys, is that I find that a lot of people are not proactive. They want
Mm,
they don't understand the system, so they're not proactive. They don't come with everything. They want a lot of stuff to be done for them.
I
Whereas
would
mhm,
like to touch on that after as well.
I'm the type of person where I really go through the whole application process, whether it's the bank
Hmm.
application. I try to collate all the things, even if it's too much.
yeah,
Even if it's
it's better
too
to
much,
go too
I
much than
rather
less.
them say I don't
Yeah.
need this, I don't need this, than they to come back and piecemeal, because they'll come back piecemeal and say, "Oh, give me that." and you give them that, and then they'll come back and, oh, by the way, we need that.
And then it's like 2 months have passed or something, you know, and
Yeah.
Right. And that's where it gets frustrating. You know what I'm saying? So I think understand the system and work within the system, and it'll be fine.
Sure. Thanks,
So
Michael. Athena?
I would like to add that we do live in the Caribbean. Fine, the Cayman Islands, they're moving forward regarding the digital communication, but not everyone is up to par there. And as much as I don't even know what they call our age group, but you know, we like to email, we like to WhatsApp, and we don't even like to pick up the phone, to be honest, because a lot of these things could be sorted through email, but not every company works like that. Fine, you have an accepted offer to purchase, and you have the deadlines, and it's your responsibility to ensure that these conditions are satisfied within the deadline. So the buyer should be treating, getting their bank financing, getting their pension withdrawal, getting their valuation, getting their stamp duty as a sense of urgency, whether it means picking up the phone and calling or actually visiting the company until it gets done. Because we do find that sometimes things get lost in translation when it comes to email, or maybe you're not treated as more of like an urgent client. So it's important to keep on top of these things. Yeah, and making sure that it's done right the first time, so that way there's minimal delays, because at the end of the day, it's you that's going to miss out on the property that you actually wanted.
And I think,
like I said too, if you're just proactive about it, I've purchased a land and closed in 14 days. I've done it in 14 days. You just have to get everything.
You have to have everything ready.
Make sure everything is right. Go
check your emails, check your voicemails.
Send the email and say, literally tell them sometimes, I'm coming in tomorrow.
Also,
and you book an appointment.
Exactly. Go on, Athena.
Also, to ensure that you keep copies of your documentation in case something goes missing. I would like to add that there is a misconception that real estate agents are able to push things for you. That's not necessarily true. And based on the data protection law, the lenders are not allowed to give the real estate agents information about your transaction. So it's important that you and yourself take care of your conditions of the offer to purchase. Fine, we can help, we now can recommend, but if you are not actioning it, then there's only so much that we can do to keep this deal together.
And I think, you know, kind of as agents, you know, we'll, out of courtesy, kind of make sure that we help, you know, keep in with that correspondence and that dialogue. But, you know, I think we've often, because of case by case, we can see typical trends. We try to express that urgency as much as possible at the start of the process, because we don't want to add any more pressure to people then needing to file extensions, or they're having issues, or, you know, because like you said, Michael, a lot of time people are seeing maybe that they have this expectant of, you know, this should be done within this window, or, you know, this should be coming to me via email on my lap and different things like that. But, you know, proactivity, going in, developing that relationship, showing that sense of urgency.
Just ensure that you have all your necessary documents and not necessarily giving your documents to the lender piece by piece, because that's when it's not really being processed, because things are being missing. Like, they need everything on their table to start your mortgage financing.
Give them your blood type, give them what you ate for breakfast, give them everything.
Everything. 100%. And just one other thing I would say is just one last thing, because I know we're wrapping up, but I think it's super, super, super important. Probably even more important than a lot of what we've been saying is that a lot of people, and Athena and I would have experienced this with clients and stuff like that. They have like a preferred lender that they want to go to, and they don't realize the power of being able to negotiate.
Yes.
And I've done that in the past with my own stuff, where I've gone to a different bank here. I've started the process here. I've also applied here. I've also applied here.
Yes.
What I'm really doing is I'm sussing out
Scoping out. Yeah.
who's going to give me the best deal.
Hmm.
And I
Mm-hmm.
might like this lender A here, and they're my preferred bank, and I do all my business here, and we have a good relationship. But lender B really wants my wallet. Lender
Mm.
B really wants it, so I will use lender B's terms and conditions and
Mm.
say to lender A, "Hey, can you match this or do better
Yeah.
than this?"
Interest
So
rates,
Exactly.
because
You're
etc.
able to apply to multiple.
like Athena said very early on, it's probably going to be the most important, biggest, most significant purchase that you're going to make. You want to get it right. You don't
Yeah.
want to get stuck with these horror stories that I hear, people getting stuck with these high 10-year fixed rate mortgages. It sounded good then, but they
Mm-hmm.
never, they what sounded good then, they don't realize that things change down the road. Plus, they
Sure.
could also have spoken to a few different, and that's also part of our job too. I think our part of our job as consultant is to advise them to say, yeah, let's also, I know these guys very well, I get all that, but let's go and talk to
Yeah.
ABC bank over here, because they also have a very good, let's put everything together and give it to them,
Everything.
see what
Yeah.
they say, and maybe they might be able to accommodate that. That's a
And
huge part, I think, that 95% of people do not do.
And I think that's, depending on your background, depending on your confidence levels, you can understand why maybe that's, people want to stick to what they know, they want to stick to their comfort zone, but that skill can be applied and transferred across any kind of purchase or many different, business negotiations. But yeah, we typically encourage clients to kind of do that so that they can get the best rate for them. And I think as we come to a close, I guess one of the key themes of today's episode is, this is your process, this is your journey as a purchaser. Take ownership of it. Take hold of it with some level of urgency and proactivity.
The recommendations as well.
Yeah,
The
recommendations and
recommendations
taking on
are
professional advice.
recommendations.
Absolutely.
Mhm.
Michael, I had to acknowledge this before we go, because I feel as though, as a fellow, with Mod and FinCay, Best of Cayman winners, have to congratulate you as well. Tell us about, this is how many years now is it you won Best of Cayman?
We've won it 2 times. Won best accountant 2 times now. We won best financial planner last year, and then we got silver for best financial services provider.
Nice. Well,
So
congratulations.
we're going for the three-peat this year for best accountant.
Yeah, 3 times in a
We're,
row.
we'll be rooting for you. And just for listeners as well who maybe are not as familiar with your services and etc., or how to get in touch with you, just where do you want to direct people to in terms of getting in touch with FinCay?
They can email me directly at michael@finkayinc.com, and we can go and have a comprehensive discussion by email and in person to try and see what we can do to meet your needs. Our slogan is independent, personalized consulting, and that's what we try to offer people. We try to not box it in to say it has to be just done this one way. A lot of people need fractional support. Fractional CFOs are just this type of niche down particular service at a more affordable rate that makes sense for them. And that's kind of like what we do.
Awesome. Well, I've loved the conversation today, and I'm hoping that listeners have gained a little nugget of information that maybe they didn't have. Obviously, as ever, we always say, do follow us, like us, subscribe. Make sure you reach out to either us at Mod Realty or Michael at FinCay. Obviously, if you're looking to kind of get that specific advice on finances. But Michael, thank you so much for joining us today, and for having this conversation. And to everybody listening in, make sure that you follow us, and do also send in some topics that you would like to hear for future episodes as well. But for now, thank you so much.
Thank you, ladies.
Bye.